Crypto price predictions can feel like modern day astrology. Colorful charts, complex jargon, and a lot of noise on social media. But beneath the chaos, a new discipline is emerging. Part science, part intuition. That's actually getting smarter. Thanks to AI, on-chain transparency, and clearer regulation, 2025 has brought better tools to making informed, probabilistic forecasts, not crystal ball guesses. Still, no model can fully tame crypto's chaos. Black swans, regulation, manipulation, and human emotion always play their part. But by combining methods like fundamentals, technicals, and even decentralized prediction markets, you can stack the odds in your favor. In this video, we'll walk through 8 strategies real analysts and funds are using in 2025 to forecast crypto prices. From Ethereum valuations based on staking yield to AI models that outperform human traders and the surprising accuracy of platforms like Polymarket. This is your fundamentals first guide on how price predictions really work. By the end, you'll not only see the tools professionals rely on, you'll also recognize the red flags when a so-called expert is just blowing hopium. In traditional markets, you'd look at cash flow or earnings. In crypto, we adapt those principles analyzing tokenomics, user growth, and utility. Tools like Token Terminal now let you track protocol revenue, token unlocks, and staking rewards in real time. And with regulations like MiCA improving transparency, fundamental analysis has matured dramatically. Take Ethereum. You'd start with staking yields, layer 2 activity, and total value locked. Rising TVL and adoption imply growing network demand. Analysts build revenue-based or discounted cash flow models that reflect transaction fees and token burns. Many now even use scenario trees, weighing bullish outcomes like ETF inflows against bearish ones like liquidity contraction. Even token unlocks, once hidden in white papers, are modeled into dashboards that forecast sell pressure. When analysts predicted Bitcoin's supply shock from the halving would drive prices above 100K, they were right because fundamentals gave them conviction. Fundamentals won't predict every spike or crash, but they're your anchor. They remind you what you actually own and whether the market's pricing reflects value or just sentiment. If fundamentals tell you what to buy, technical analysis helps with when. By 2025, TA has evolved from hand-drawn trend lines to AI-augmented platforms that identify patterns automatically and backtest them in real time. Traders still rely on core tools like moving averages, RSI, MACD, and Bollinger Bands, but automation now detects startups faster than ever. A classic example is the 50-day crossing above the 200-day, signaling bullish momentum. Combine that with volume spikes and a Bollinger breakout, and you've got confirmation of strength. That exact setup helped traders catch the recent Solana rally before its 50% surge. Technical analysis also captures market psychology. Fake buy walls, for instance, can manipulate sentiment. That's why experienced traders track order flow and funding rates to gauge leverage imbalances. And one of the biggest upgrades in 2025 is the multi-time frame analysis, zooming out to weekly charts for the macro bias and then drilling into shorter time frames for precise entries. It filters noise while keeping your view flexible. TA isn't magic, it's a timing tool. When it aligns with fundamentals and sentiment, that's where the edge lies. Unlike traditional markets, crypto's data is public. You can literally watch money flow across networks. In 2025, AI-powered dashboards have made this process smarter and faster, tracking smart money behavior, whale movements, and real-time wallet activity. Metrics like the MVRV Z-score help identify overvalued or undervalued conditions. The Puel multiple flags cycle tops when miner revenue peaks. The SOPR shows whether investors are selling at a profit or loss, hinting at sentiment shifts. On-chain data also uncovers hidden narratives. Spikes in unique addresses and rising TVL on Ethereum or Solana often precede rallies, while large transfers to exchanges can warn of dumps. Analysts even use wallet clusters to trace VC fund behavior or coordinated sell-offs. Before Ethereum's recent rally, on-chain tools detected rising staking deposits and layer 2 activity weeks ahead of the price move. That insight gave traders a 30% predictive edge over purely technical models. The takeaway is on-chain data doesn't lie. It's not opinion, it's evidence. If you're not watching blockchain activity, you're trading half blind. In crypto, prices often react more to emotion than logic, especially in the short term. Understanding crowd mood has become essential. By 2025, AI sentiment models can scan platforms like Twitter, Reddit, YouTube in real time, detecting shifts across millions of posts. The Fear and Greed Index still serves as a quick pulse. When it spikes above 80, markets are usually overheating. When it sinks below 20, opportunity is brewing. Traders now merge these signals with TA. If sentiment is euphoric while RSI is overbought, that's a sell signal. Conversely, extreme fear often aligns with accumulation zones. Meme coins illustrate this perfectly. A single viral post can ignite a 50% move overnight. Smart traders use AI tools that track social engagement and keyword velocity to spot these spikes early. In short, social mood is data now. Learn to read it and you'll understand the emotional currents driving short-term volatility. Machine learning has become one of the most powerful forecasting tools in 2025. Once reserved for hedge funds, it's now accessible to retail through open source libraries and decentralized AI platforms. These models digest massive amounts of data, price action, sentiment, on-chain metrics, and identify patterns too complex for humans to see. LSTMs, GRUs, and ensemble models like XGBoost blend technical indicators with real-world activity to generate adaptive predictions. For instance, an XGBoost model predicted Ethereum's 4-hour trend with 65% accuracy during the Q2 rally. It wasn't perfect, but that small statistical edge used consistently can compound into serious gains. Decentralized AI platforms like Alora take this further by crowdsourcing forecasts, rewarding the most accurate contributors in real time. It's like prediction markets powered by AI. But remember, AI isn't magic. It's only as good as its data. Models trained only on bull markets collapse in corrections. The best traders treat AI as one layer of analysis, not a substitute for risk management. Prediction markets turn sentiment into probabilities. Platforms like Polymarket now handle over $1 billion in volume, where traders bet on outcomes like, will Bitcoin close above 100K this year? Now, if that bet trades at 60 cents, the crowd gives it a 60% chance of happening. Because these markets are decentralized and transparent, they often outperform traditional analysts, especially in fast-moving or uncertain conditions. During the 2024 election, Polymarket odds for crypto-friendly candidates shifted hours before polls closed, capturing investor sentiment that mainstream outlets missed. Some traders even use these markets for hedging. If your analysis points bullish on Ethereum, but the crowd gives it only a 30% chance, that discrepancy might signal opportunity or overconfidence. Crowd wisdom isn't infallible, but it adds a valuable dimension. It's another signal, but not the only one. Quantitative models bring structure to uncertainty. Borrowing from traditional finance, crypto quants now use tools like ARIMA and Garch to forecast volatility rather than price direction, helping funds manage downside risk during turbulent periods. Monte Carlo simulations run thousands of randomized price paths to map probabilities instead of single outcomes. Dynamic Bayesian models update forecasts instantly as new data arrives, whether it's a Fed rate cut or a spike in ETF inflows. These methods integrate macro data, bond yields, liquidity cycles, and global risk appetite into crypto forecasts. When Bitcoin hovered between $55,000 and $65,000 during the post-COVID volatility, these models predicted the range accurately, keeping funds disciplined when others chased extremes. Quant models don't care about hype, they measure probabilities, not promises. And that's what makes them timeless. Here's the truth. No matter how advanced the model, predictions will never be perfect. Markets move on emotion, manipulation, and randomness. The goal isn't to predict every outcome, it's to narrow the range of possibilities and act with discipline. That's why the smartest analysts now use hybrid frameworks. They blend technical setups with on-chain data, feed machine learning outputs into sentiment dashboards, and validate quant forecasts against fundamentals. Each layer filters out bias. The best practices are universal. Backtest your strategy across past cycles. Journal your predictions to separate skill from luck. And stay connected to credible communities where collective insight moves faster than any single trader. Use the tools, but please respect their limits. Treat predictions as inputs, not certainties. Build risk management into every decision so one bad call never ends your crypto journey. After exploring fundamentals, technicals, on-chain metrics, sentiment, AI, prediction markets, and quant models, one truth stands out. No single tool gives you the answer. The real edge is in integration, layering data, filtering noise, and staying humble before uncertainty. Crypto will always be unpredictable. That's what makes it exciting and dangerous. But when you use the same analytical frameworks that professional funds rely on, you replace guesswork with structure. And if you want to keep deepening that foundation with real education, not hype, check out learningcrypto.com. It's where we share the strategies and insights that help you navigate this space with confidence and independence. In the end, prediction isn't about certainty, it's about preparation, probabilities, and discipline. Use the tools, but never forget the golden rule. Don't trust, verify.